Okay, everyone, good afternoon and welcome to the AOP June Outlook call. Usual format, we'll have a lovely 20-minute presentation on markets from Gary Duggan, our CIO based in Dubai with the Global CIO office. He's having great fun since Trump's Liberation Day predicting markets. And along with that, we have a guest, Jacob Rumble, a private credits guy. He's from one of the US's most friendliest tourist states, which is Canada. Usual format, it's a webinar, Q&A. There's a Q&A box. We'll hand it over to Gary. Gary can give us an overview, and then Jacob will get some insights from you on private credit, specifically in the Asian region. Gary, okay, you've been doing this for 30 odd years. What's tomorrow going to hold for us? Because this is great fun at the moment.
Yeah, we're living day to day. I'm just putting my presentation up. It's just hanging a little bit. Oh, here we go. Hopefully you can see that. Yeah, I'm going to try and an update on what I talked about last time around and kind of keep a common theme going. There's a little bit more on the financial markets in this presentation than there is in the macro, because I think we know what's happening in the macro, but we don't know where it's going. So let me just start with the financial markets. This is just color coded so you can just see the good stuff and the bad stuff. And interestingly, I mean, if we went back to the middle of April, this would have had a lot more red on it. So these are the returns of the individual markets and asset classes over year to date, 12 months and down to 1 month. It's interesting that if you actually look at that 12-month column, the numbers for most of the equity markets are all in the same range of around about 10%. But of course, what we've had is a remarkable recovery of Europe, which is up 10% year to date, relative to the US at just 1.5. So the US went down a long way and has rebounded, almost as if to say, and what's the problem? But I'll come on to what the problem is later. Emerging markets have put a very stellar performance in, and in bond markets, not too bad, considering that we've still got our fears about inflation risk. So first picture and comment is on tariffs. It's still very uncertain. I think I used a graphic on the left last time round. So just a reminder that the blue line shows the kind of average tariffs of the United States over some decades. And we were down at a number of around about 2.5%, 3%. And then President Trump came to power, and on that fateful day took the average implied level of tariffs based upon what he had said with his kind of scoreboard. It took that up to a considerable 30%, and negotiations have been ongoing ever since. Now, I'm hearing all sorts of things, and there is no definitive consensus view at one point. But I would say that if there's a point that you want to keep in mind is that the most likely outcome at the moment, if there's any confidence about likely, is around 12 to 13%. Which would still represent a material increase in the amount of tariff going on to products arriving on the border of the United States. Now, just to give you a bit of background to the most recent issues, we had the Court of International Trade basically outlaw it, and then with the appellate court say, okay, we better think about it. The appellate court will still take some weeks before it comes to a conclusion. And even at the end of everything, they decide that no, he can't put his tariffs on. He has these what's called sections 301, 232, 122, 201 and 33A, which all of these that he could invoke to still put tariffs on. So the idea we've got a definitive answer coming in the next month is absolutely fanciful. And I think this will still be rolling on in some months to come. So let me just talk about what's to come. So what is it that we're going to be seeing in terms of macroeconomic data and the general mood in the global economy? So what you have in front of you on the right-hand side is the quarterly path of GDP growth. I would call it a consensus forecast quarter by quarter. So what's happened is that the first quarter has been stronger than expected in many places because there's been a lot of front loading. Even if we didn't know what the tariffs were going to be, there was front loading of demand where companies were importing because they were worried about what tariff levels. The same thing will come to pass in Q2. But when we get to Q3 and Q4, this will be the impact of tariffs hitting. And in the case of the US, that means that growth will be close to zero, at least on the consensus forecast at the moment. Now, that's quite a contrast with the rest of the world. So this is now, I would say, it's kind of starting to feel like it's the US versus everyone else, both in terms of growth and inflation. So on the growth side, we've had two good quarters where we might have just felt that everything was okay. And so to give you an example of that, what you have on the left-hand side is the path of consensus forecast for each quarter's growth. And you can see the orange line that goes up, which says that at one point we thought the US would only grow at around 1% this quarter, and now it's likely to be 2.5. So when companies tell us that things seem to be okay, it's really, as I said, it's the dawn before the problems hit, because in the second half of this year, we're going to be struggling with growth in the United States. So as I said, so I think there's a degree of complacency because things have looked better than they are, but they're better than they are because we've got problems on tariffs going forward. And the same thing comes with inflation as well. And again, a marked contrast between what's going to be experienced in the United States relative to the rest of the world. When you think that China's in deflation, if you put tariffs on China, it ain't going to make very much difference. You're still going to have a low number and you still have the ability to keep interest rates low. But look what's happening to that blue line for the United States. So inflation, which today is around about the 2 to 2.5% level, again, a general consensus view, although this chart I took from JP Morgan will say that the quarterly annualized rate of inflation in the second half of this year will be approaching 6.5%, averaging 6%. That's what companies and consumers will be feeling. There'll be this sharp acceleration of prices in the shops and in general life, which is going to cause a pause in growth, we believe, and it's going to certainly do some damage, I think, to the bond market. Contrast that with Europe, where the appreciation of the euro and less tariff problem in terms of products going into the country, and similarly in the emerging markets, we take out China and Turkey, it's hardly unchanged. So the real shock is coming in the US. And the other thing that's coming in the US, again, contrasting with the last conversation where I was worried about this, but we're now getting it. But what's coming is more debt. The House has passed the budget. Now, I find it quite interesting here, and I think there's been a little bit of politics, but the CBO, so this independent body in Washington, which makes forecasts about the deficit, came out with a number of $2.4 trillion, which everyone was saying, at least the government, was far too high. But actually, the consensus has been it's 3.8. And I think the CBO, in a sense, might have been nobbled sometime in the last month, because the numbers that have been quoted for the impact of all of this, of all of the spending increases, tax cuts, is to put about, let's call it $2 to $4 trillion on debt. The debt has to come down. It should be a negative number, not a positive number. So it's kind of splitting hairs to say whether it goes up by 2 or 4. It shouldn't be going up. And this is what the bond market is worried about, and certainly more worried than when we spoke last time. So how can we measure that worry? Well, we can see what's been happening to long-term bond yields. The blue line is the US. We've also had some problems in Japan, but in Japan, it's partly about communication, because the market's been worried about a very significant increase in supply of bonds. And the Bank of Japan, I think, will address that. But there's two things you would take away from this. One is, do you want to buy a hard currency like the yen has been over recent months, where it's been appreciating against the dollar, and also get paid 3% on a 30-year bond? Or do you want a US Treasury yielding 5 in a country that's seeing a depreciation of the currency? And that, I think, is a really important question as we go forward, because there is something remarkable that's changed in just the last few weeks since we had the tariffs. And I think this is a bit of a warning for the markets. And it's this picture. I don't often highlight and put an ugly yellow around a word, but it is a warning. So what is this chart showing you? Well, if you can make out the chart below, there's two lines on there. One is for the US 10-year bond yield, and the second is for the spot rate of average spot rate of the dollar, so dollar strong or weak. Typically, what's always happened in the US is that if interest rates go up, people pile into the dollar, and the dollar appreciates. And the correlation between dollar and long-term interest rates is a high number. And you see at the top there, the green, the blue line on top is showing you the correlation between bonds and bond yields and the currency, the dollar. That has been very consistent. They're both running in tandem. Well, what's happened ever since Donald Trump stood up with his great new plan for tariffs, this line, this correlation has broken and has come down a long way. So now when yields go up, the dollar falls. Where else does that happen? A banana republic, quite frankly, in terms of economic policy. This is when the market is very concerned about the scale of the debt. It's worried about inflation, and it gets manifested itself in a weakness of the underlying currency. I mean, if you want a good example, take the demise of the Turkish economy and the Turkish lira over the last 15 years. So to me, this is a warning. I have never seen such a significant change in the relationship between two major variables in the US economy. I can't remember when I saw this last, and certainly not at this critical point where we are worried about bond yields. A further worry in a more modest way is if I look at real yields in the US. So the gap between the 10-year bond yield and inflation, if that's widening, it's basically saying the credibility of monetary policy is falling. And so the US has been through a transformation since the 1990s through to 2020, when that risk premium was constantly falling because the credibility of the Fed was so good and the credibility of economic policy was okay. And we went from a regime where the real yield was somewhere between 2 to 4% down to 0 to 2. So the early years were Greenspan getting the credibility of the Fed. Well, now we've got concerns. We've got concerns about political control over the Fed, maybe next year when Jay Powell will end his office. At one point, we thought he was going to be forced out of office. And secondly, we've got this concern about the budget deficit. And thirdly, about the fall in the level of the dollar. So when we put all those things together, that's why this line is trickling higher. And as I said, maybe it's going to break out to the higher end, which means that the US government will have to pay more for it to service its debt. And interestingly, the one statistic that wasn't talked about very much yesterday from the CBO, the Congressional Budget Office, was that they are now saying that in the next decade, the US will have to pay in dollars twice as much as it has done in the past to service its debt. So where's that money going to come from? From borrowing? That's just and that's the end of the world. But that is the most important statistic from yesterday, and not whether it's 2 or 4 trillion. It means the servicing of this debt with yields going higher is going to be a material problem for the US economy. So what are we expecting in terms of interest rate cuts, and how might the Fed react? Well, with an assumption of inflation at 3.5% by the end of the year, which is a consensus, and that unemployment doesn't rise very much over coming quarters, it's hard to see why the market is today pricing 2 rate cuts by year end. Now, the employment data from ADP yesterday was a little bit weaker than expected, but I don't see a materiality yet in terms of employment collapsing to mean that there's going to be a kind of a shock in the Fed to believe that they're going to turn around and cut interest rates. I still would say that the greater risk is of fewer, if not 0 rate cuts this year, than 2 to 3. So where's the good news? The good news is in the rest of this presentation, where I'm going to talk about things that are going right. I mean, the purpley line there that you see is the degree to which economic activity in the Asia Pacific region is surprising to the upside or downside. And we've now had a number of months, consecutive months, where things have surprised to the upside. Europe and the United States are around about the same area, but the European picture looking a bit more confident. And just on the bottom there, what I'm saying here is that we've seen quite a sizable cut to expected US growth, whereas globally it's held up well. And the China numbers are actually higher than where they were compared with the beginning of this year. So good news there. Less good news in general is that earnings forecasts in each of the major markets has been coming down. The green line is actually the European one, not the US. The one in the middle is the US, and the top one is Japan. But if you actually look at what people worry about, it's that the numbers in the US will have to tumble with that slow growth, inflation problems, instead of getting profits growth this year, as is still estimated that growth will be around about 10%. The market actually says that from a macro perspective, it could be -7. Whereas in Europe and Japan, the numbers could still be where they are today after the modest downgrades. And argument is, well, okay, you say all this, Gary, but markets have moved already, particularly Europe. Well, yes, they have moved, but Europe is still on a 10-point P multiple gap to that of the United States, which is what you see on the right-hand side. And by the way, European yields in general are lower. So if you've got low yields, you've got reasonable growth, your P multiple can expand. If you've got rising yields and you've got a very high valuation, it's greater risk that your market does not do well, which is the United States. So still pro-Europe. And I do think there's a feeling here that the emerging market could break out after its very consistent underperformance that you see on the left-hand side there over the last decade. Valuations are cheap, and we're seeing people looking for value. So on the right-hand side, there are a series of markets in call it the broad emerging space, which includes Latin America and Europe, where those markets have given 20 to 25% returns year to date. And I think there's still more to come through because many of these markets are still on single-digit PE multiples. And one market that I think could surprise is China. Now, China needs good news flow because the news flow is the blue line. So the degree to which economic activity is coming in above or below expectations, that has been on a rising trend. And what we've seen is that every time the data gets better, the Chinese market has a real pop. But I think there are other reasons for wanting China. Remember, in China, you've got close to zero interest rates. So retail investors are coming out of cash deposits and out of the bond market and into equities. International flows on some measures are some of the strongest that we've seen in some time. Earnings forecasts, tariffs or no tariffs, are still relatively robust and have been going up. And the government is still making very consistent efforts to encourage consumers to be positive and to go out and spend. And we've been hearing stories, obviously, about subsidies to go out for dinner. But China has that consistent story. It has a product at the right price. It has a quality product at the right price, and it has a story. And I think one thing that I would take away from the last 24 hours is Trump virtually giving up on his negotiation. And he doesn't have any cards to play. It's almost like his Zelensky moment. And the Zelensky moment, in a sense, is that he does not have something he can beat the Chinese up with. But the Chinese are beating up on him at the moment because they have stopped or cut by 50% in April this export of rare earths, which is so crucial to the tech industry. And to finish with the more sobering picture, which is that these are two assets you definitely do need in your portfolio. They are gold, and I call it digital gold, which is, of course, Bitcoin. Gold has been given the more consistent performance, but you can see that it's kind of grab Bitcoin again and says, get back up here. So I would say portfolios today are going very ex-US. They still need the security of things like gold and digital gold. And I would say if there's one bet or one position I take on for the next quarter, it's that long Chinese equities view based on what I showed you earlier. Back to you, David.
Gary, thank you for that. Just before we go over to Jacob, I think you said you were going to give us a calm theme. You mentioned the word worry 12 times, and we had to get to slide 11 before we got to the good news. Awesome. Jacob, calm themes and private credit. You gave out to me earlier for saying that there was no private credit market. You were a shadow banker. So I apologize for that. You are a legitimate shadow banker, regulated and all. Maybe you can give us your view on where private credit is today in Asia and some of the things we should look out for both as investors and businesses looking to tap into private credit markets.
Sure thing, David. First of all, thanks for having me on. Before we jump into it, I will note the absence of a tie, which means I'm certainly not a banker, at least here today. Yeah, and maybe just to give a little bit of background on myself, and before giving you the opportunity to label me as an American, I'm a Canadian who's been based over here in Hong Kong for the better part of 10 years. I've spent my time primarily working in the alternative space, and over the last 7 years working in direct lending and private credit, having most recently worked with a small hedge fund out here. Now working with an Australian business, Oriana, and leading our private credit capability. In terms of our group, just very quickly, we have a reasonably sized family office down in Melbourne, fairly large private property development and construction business, also down in Melbourne. In Hong Kong, we have a private wealth business, which also extends to Australia. And in that business, we've got about 16 billion Australian dollars in assets under advice. As a group, we're creating some very interesting investment opportunities and products, and I cover everything on the credit side. So, I think it's useful to start with a backdrop, perhaps before we get into the details. From a global perspective, private credit these days is sitting somewhere at 3 trillion in AUM as at the end of 2024. Now that's an estimate, given the opaqueness of the space, but it's probably a reasonably good one. Interestingly, Asia Pacific only comprises, depending on which source you're looking at, 6 to 10% of that total AUM, despite on a purchasing power parity basis, Asia Pacific constituting 46% of global GDP. So there's clearly a misalignment here and an underallocation. That said, the tide is changing and the trend is starting to turn here. You are seeing increased allocation into this space in Asia, perhaps not with the same volume and velocity that managers like myself would like, but capital is coming over here, and that's at the moment primarily for 3 reasons. The first is, despite the doom and gloom over in my home continent and south of the border, the U.S. remains a pretty fertile ground to deploy private credit and to raise funds. But investors are increasingly looking at diversification, and particularly Asian investors are looking to Asian managers and Asian opportunities in terms of diversifying their private credit portfolios. That sort of boils down to a couple of things. Historically, we've seen better returns or relative alpha generation in Asia from Asian managers versus US and Europe. We, can also see a better beta capture in these managers, given the ability to capture what are some pretty phenomenal lending opportunities in a part of the world which is just less capitalized than US and Europe, both in terms of banking and also overall capital markets. Begs the question, if you're looking to allocate into the space or are already allocated into the space, what should you be paying attention to right now, and what should you be considering when you're deploying your funds? There's a lot in short, but there's probably 3 things or 3 trends that I would focus on right now, and that we as a business are particularly focused on. The first is, this recent trend, which is coming fairly fast and furious, of new private credit fund launches marketed as semi-liquid, or some that are even liquid. And broadly speaking, these funds are generating monthly liquidity for investors, which they're effectively looking at as income, and it differs from the previous allocation opportunities, which have largely been sort of mid-dated close-ended funds. The challenge here is really an asset liability mismatch identification question. And it's all very well and good to seek semi-liquid opportunities in private credit and realize a yield that outperforms what you might be able to get elsewhere. But you need to look pretty closely at what the underlying investments are there to ensure that they're capable of supporting that liquidity or semi-liquidity. And we would encourage investors to not just read what's on the tin, open it up, take a look, and make sure that you sensitivity test these investment opportunities and ensure you're going to be able to get your cash and your return when you need it. The second point, and this is particularly an Asian point that I'd like to touch on, is what we are seeing in the market being the 80-20 rule playing itself out, where broadly 80% of managers, 80% of capital is it's finding its home with 20% of managers. And I'm not going to name them here on this show, but it's the usual bulge bracket type names that you'd expect. The challenge in Asia is that, again, we just don't have the same depth of a market as we do in US and Europe. The sponsors market here is substantially inferior. Capital markets generally are much smaller. And the question is, when these managers continue to raise more and more capital, where are they going to put it all, and how are they going to deploy it in a way that gives their investors an appropriate risk-adjusted return? We would advocate looking at maybe smaller and mid-sized managers with well-defined strategies, and I'll get into that in a second, where, again, these managers are able to capture relative alpha, but also deliver on beta because they're extremely focused on markets, whether this be or geographies or particular sections of the world or sectors where they know them extremely intimately, and for that reason are able to ensure they can deliver on preservation of capital. With that said, my third area of focus here, and something that we at Oriana are looking to do pretty aggressively at the moment, is in identifying managers with strategic capability. And that can come down to, broadly speaking, a couple of things. I think it's either a very strong geography focus, or I think it's a very strong sector focus. And if you know your market intimately and in a deep way, this allows you to do things that other managers just can't. And getting a little bit granular here, that means you can identify better deals and identify off-market deals before they go to your competitors. This makes your underwriting tighter, faster, more efficient, and hopefully more accurate. This allows you to manage these positions in a way where you reduce your default risk ultimately and ensure you're being paid your income on time. And finally, if you haven't done the first three right, which does happen from time to time, it gives you a strong work capability where you know exactly how to step in, manage the assets, and ensure that your investor capital is protected. So I guess in summary from my side, it's an interesting world at the moment. From where we stand, and certainly from where I stand, think that Asia and Asia Pacific probably deserves a better shake. We'd like to have more capital coming this direction. We think there's phenomenal opportunities for investors to deploy and realize outsized alpha with more beta capture than they're going to be able to get elsewhere. But all that said, they need to be reasonably careful about where they choose to deploy and who they choose to work with and allocate to.
Jacob, I got a question. Jacob, sorry, Jacob, quick question for you though. Is there much difference in the regulation here in Asia as there is, say, in North America? Is it less regulated here?
Certainly, and I think this is what most commentators on this space would speak to as the real handbrake on capital allocation. Asia Pacific is not a single homogenous market. It's it's dozens of extremely complicated ones, some with impressive track record of legal precedent and very clear and efficient legal systems as far as creditors are concerned, and some that are not. So, again, when you are looking at who you choose to work with as a manager, you should be very focused on where are they deploying your capital, and do they understand these jurisdictions?
I mean, you've had experience across multiple jurisdictions. I mean, I feel like the cynic in me will say that Australia doesn't have a private credit market. It has a mezzanine construction finance market that's funded by managers. And then Southeast Asia has a shadow banking market. I mean, maybe you can give us insight to still on the call what you see some of the key difference in the asset classes of private credit investments in different markets.
Yeah, it's a good question. It's a very good question. I think that, broadly speaking, private credit, again, it has a pretty opaque definition in and of itself, but to keep it simple, this is non-bank lending, and that means different things in different places. When you're lending, you really have two focuses: preserve principal and realize a reasonable spread over the risk-free rate. In each jurisdiction, in each market, that means different things at the moment, and that's both influenced by, it's influenced by everything, right? It's macro risk, it's geopolitical risk, it's local interest rates, it's currency risk, it's issuer risk. But ultimately, you as an investor need to think about what you're exposing yourself to, and there are certainly some markets in Asia where you may dress something up as credit, but ultimately you're probably bearing equity risk, because if you had to force an outcome, you're not going to be treated as a creditor within that jurisdiction. You raise an interesting point on Australia. It's a market that is attracting a gargantuan amount of capital. It's probably been, alongside India, the biggest beneficiary of risk off China. But the downside of that is you've got a lot of capital flooding into this market. And the question that any investor should be asking themselves is, are they being compensated appropriately for the risk that they're taking on? Ultimately, that comes down to manager selection and transparency, right?
Come down to transparency and manager selection. I mean, I know you've got a bit of experience with Indonesia. What are your anecdotal or experience thoughts in relation to the private credit deals in Indonesia?
First of all, a lot of headaches the next day. Warm whiskey and cigars tend to have their effect, but Indonesia is a market I wouldn't say I'm particularly intimate with, and the anecdotes that I do have, I'm not sure fit for this this show here. But at a high level, I think Indonesia is a phenomenally interesting market. It's I'm not an expert in geopolitics, but it seems like they seem to have cornered the power game in Southeast Asia, and it almost looks like Indonesia is starting to dictate how their neighbors are behaving. It's a huge growth opportunity. From a Western perspective, it's an enormous anti-China hedge, or sort of anti-China bludgeon, depending on which way you want to look at it. But credit there is complicated. You have very large sponsors, listed businesses, families, who have been traditionally well banked by both the local banks as well as regional players, and also the funds. Sometimes that's worked out for investors, sometimes it hasn't. And the reality of that market is there is no mid-market whatsoever. And sort of once you start to get outside of these large conglomerates and sponsors, you're getting into reasonably hairy territory. So those would be my thoughts without going deeper.
Yeah, no, I appreciate that. You do talk about that mismatch. It does feel like in Asia we have a gap, a real funding gap, where the banks are just not stepping into the SME market. And then we have a very transaction-based wealth management, which is focused on selling a product with a coupon on a yield. And to your analogy, nobody's really opened the tin to figure out what's inside it. Would you concur that's probably the way that's effectively what you're saying? We've got to be very careful. So then I would argue that surely the big allocators of capital would be reluctant to take on local individual managers, but would rather stay within the big bulge brackets because their jobs are at stake.
Yeah, I mean that's always a consideration when you're investing, right? Is there's a certain set of names you can allocate to, and you probably won't lose your job over it, despite the outcome. It ultimately, Dave, it depends what investors are looking for. There's some very good managers out there who haven't gotten to the $50 billion mark, who are very focused on particular geographies, very focused on particular sectors and strategies. And again, as part of a diversified private credit allocation, that makes a lot of sense.
Good.
Rather than sticking it all with one big name.
So Gary, as an one big name allocator and CIO, what are your? I mean, you recommend some of the best managers. I mean, obviously Jacobs should be on your list. But what do you look for? What are you looking for when you're allocating, doing your due diligence on behalf of groups, particularly in the private credit space, specifically to Asia?
Yeah, well, I think Jacob's made the point already that a lot of asset managers, money managers, and family offices tend to want to stick with the big brand names because it appears dangerous to go elsewhere. But I've been much more in the camp of looking for the medium-sized, the new guys on the block, and in part that's because when I look at the scale of some of these funds that are being built by some of these big brand names, I'm almost saying, what are you going to do with the money? Trying to deploy 3 or 4 billion at once and satiate people's demand for income typically ends up with tears because people are desperate to try and find somewhere to kind of hide the cash out in order to show that they've deployed quickly. So I've been much more interested in researching smaller, more dedicated private credit funds in a certain specific area that you're quite comfortable with. And that to me is an easier allocation than, as I say, just giving it to the kind of equivalent of a BlackRock into the private credit market and hoping that you're going to get some surprises to the upside on the kind of returns that you might anticipate.
I mean, this is whole you talked in a bunch of questions have come in from your presentation, but one, I mean, just you've got this flight of capital in the US as the whole dollar's depreciate. We're going to see some of that money come into private credit in this market, do you think? Jacob or Gary? I mean, do we want to see more US dollars, more US dollars?
Yeah. I mean, I think I already mentioned it, Dave. Yeah. I mean, speaking to a few investors, and there's a few conferences around town over the last couple of weeks. The flow, particularly from APAC focused investors, where they had previously been entirely US and potentially Europe allocated, is now starting to come back this way. And it's not a wholesale dumping of US. We can't call it that, but it's a turn to diversification here. Yeah. That's what I'm seeing.
Good. All right. And then one other question that's come up is that how do you allocate currencies in this market? I mean, you mentioned the yen, you mentioned the dollar. How would you be allocating? What would
Well, yeah. I mean, people say, what's the allocation? You go, well, it's just have less dollars, So if you're starting from 100%, as people do in the region I sit in, whether it's their dirhams or the dollars, you've got to say that there must be risks out there that you're not mitigating by sitting 100% in dollars. So people passively, for example, sit here and just leave their money in a dirham deposit, and yet our lifestyle is about imported products, which are often priced like some brands of alcohol in euros. So I would say that something like 20% of the money that you're living off is sitting in dollars, must at least be in other currencies now. And that may just be buying, you've got no natural things that you're buying in yen, but buy some yen, buy some Swiss francs, put some deposits into Singapore dollars, put some money into euros. And I just worry that if I look at that chart of the DXY on a Bloomberg screen at the moment, it's fallen about 10%. And it could easily fall a further 10% if you go back to, let's just say the history of that chart in the last 10 to 20 years. And we're on the cusp of this breakdown and a breakdown of confidence. So as I said, it's just wrong to say you sit in dollars on everything you've got. And the last point I'd make is that, and we've mentioned this, I think, on a previous call, that the dollar pegs are up for a discussion. I used to work at major banks here, and I just could not mention the peg, otherwise I'd be run out of the country. And now people are having an active discussion, because the different discussion now is whether some of these peg currencies appreciate against the dollar if they were taken off the peg, not depreciate. And the other problem is that many of the countries, particularly here in the UAE, we're an economy built on real estate transactions. Well, the last thing you want in the world is to be following dollar interest rates higher in that kind of environment. So I would say diversification away from 100% dollars is absolutely needed.
One of the points you made too was about the unemployment in a previous call on the window dressing, where really what we're doing is culling migration, but keeping the unemployment rates. But if you take a look at your numbers in relation to the realized inflation, I mean, with all the lack of activity coming through the ports in LA and out of China, there must be layoffs, there must be real unemployment, and we must be about to see some real pain on the streets in the US come Q3, back to school, and Q4 coming into Christmas.
Yes, absolutely. You will see these numbers of redundancies, of people losing their jobs. It's just that the labour market will not tighten up what I would call materially. I mean, if you go back in time, they would say the Fed ain't going to do anything until it either sees a very sharp accelerate or a sharp increase in the unemployment rate, or that the unemployment rate goes through 6%. So if we just drift towards 6, they won't do anything until we get there. So all I'd say is that for those people who think that the economic conditions are going to generate the kind of unemployment rate that you would typically get, no, it's not going to be the case. The closing of the border, taking people off the streets, is materially reducing the net migration into the country, which used to contribute about 40% of US GDP growth. So less growth, maybe fewer people in work, but everyone will be competing for them, and the Fed will worry about wage inflation.
Yeah, and then but you also make the point that while there's a shift here towards China, I mean, China still has some systemic issues. I mean, it's still taking its medicine on the property. It still has enough wholesale lines for FX, but it does seem to be bouncing back. All the entrepreneurs I know who've got businesses there do seem to be quite positive about it.
Yeah, I think we've got to the point of saying, do I want the systematic problems of China or the United States at this point?
Yeah.
I don't know. Right. So I think we know the story in China, and we can see a program by which they're trying to improve things. And people can talk about the banks is almost a vibrant sector in the market at the moment. The issues in real estate are probably moving away from first and second tier towns and cities, and they're still in the third and fourth, but at least it's been resolved in the very biggest places. And there has been no rush for a massive fiscal boost and increase in indebtedness that we had in the past. So it's much more, let's just call it sensible policy making. But the big breakthrough in China through the tariff news was when we had the DeepSeek, and we've had Tesla issues, and people all of a sudden realize how good a BYD car is. It's a recognition that China is producing high quality products at the right price, which is what the world wants when we're trying to beat inflation.
So then we come back to Asia, we come back to this funding gap, we come back to Jacob. Jacob, you're saying, it's the private credit market, there's a gap, we're under allocated. Do we think we're going to get overcrowded? Do we think we're going to come into so that then there's a need for regulation and a need for management of the managers that are coming through? Is that where you see the next trend coming, Jacob?
Yeah, it's a good question, Dave. I mean, the interesting thing about Asia at the moment is, unlike US and Europe, the banks, I think broadly speaking, comprise something like 75% of all lending, whereas it's the non-bank lenders and funds who sort of comprise the remaining 25. That's obviously not the case elsewhere. And, there's certainly room to grow, but the question is, where is that fund growth going to be? The markets that reasonably most global allocators want to be exposed to are the developed APAC developed markets with very rock solid legal jurisdictions with plenty of precedent, and that's Australia, New Zealand, Hong Kong to an extent, Singapore, Japan, Korea, potentially Malaysia, depending on who you're talking to. And barring that, it has been difficult to get large institutional investors to allocate to these markets. That said, and some of my former colleagues like to talk about a fair bit, is this growing Asia for Asia trend, where Asian investors, families, strategics are just starting to say the rest of the world, and particularly the US, where we focus a lot of our attention, is just too volatile. And from a long-term business planning perspective, we don't know what the with the guy that's in office at the moment, you don't know what the next 12 hours looks like, let alone the next 12 days, 12 years. And there does seem to be an increase in deal activity within region. That's going to require financing, full stop. And to the extent you can supplement the banks with fund managers and other sort of allocators who are coming into that space, that seems to make a lot of sense. And it's a virtuous circle. You start getting this increased deal flow, you start getting this financing coming in, and growth begets growth. So I
agree with
I'd
that.
be positive on it.
Yeah, no, this Asia to Asia trade, we see it too. I mean, people forget that there is no real mid-market, even private equity players in Asia. They've all grown up to be bigger guys, bigger fees, and you've got real businesses here that are Asian businesses that are looking for capital, and we're limited in how there's not a lot to allocate from that. Okay, well, guys, I guess a couple of things out of this. And Gary, this is we're really looking forward to your boring presentation, where it's really calm out there in the next couple of months. Jacob, thank you very much for educating us all on private credit. Anybody who wants either of these guys' details, please come back to me directly. I listened to a very interesting interview last night with David Einhorn from Greenlight Capital, the Great Value Fund, and I thought he quoted it up, the USA First policy of Donald Trump. He said the USA first is actually going to put the USA last. So I think that's an appropriate way to leave it. Gentlemen, thank you very much for all you guys dialing in. Please give us a contact if you need us, and we'll talk to you again. Thank you very much, guys.
Thank you, David. Thank you, Gary.
Thank you.